Okay, let's get started. We got a lot to get through today. Welcome to the January 17th edition of the Fats, Fuels, and Oils webinar. Just some housekeeping before I get started. We typically wouldn't have a webinar this week, but I'm going to be gone next week. So next week we won't have a webinar. And again, I don't want to do 2 weeks where we don't. Next week, I'm going to be at the Clean Fuels Conference in Tampa. And so if anybody's in Tampa and you want to get together, please shoot me an email, or if you're going to be in Tampa, hopefully I will bump into you. All right. And then the other thing is, this week we're going to do something a little bit different. I'm going to stay basically focused on biofuels for most of this week's webinar, because what I want to talk about is whether the biomass-based diesel production in 2023 and really 2024 and 2025 will be driven by the mandates, or whether renewable diesel capacity utilization is going to drive that. And I think that the market's reaction to the release of the preliminary mandates by the EPA suggests that it believes that the mandates are going to, or at least the mandates are going to be the primary driver of biomass-based diesel production. And if you look at that, and that's sort of the way that we've typically forecast production, if you look at that, what it implies for renewable diesel capacity utilization based on our assumption for the growth in renewable diesel capacity utilization is that it stays relatively lower than it has been historically. And so I think, again, I think this is probably for the feedstock markets. I think this question is probably the most significant question for prices coming over the next year, certainly. And then depending on how much capacity grows after this year, potentially in 2024 and in 2025 as well. But let's get into that, and then I can kind of show you what I'm thinking. Okay, so before we do that, the one thing that I want to talk about, because this is the other thing that I think is really important, and we talked about this before, is the U.S. soybean oil average yield. And so we just got the NOPA data for December, and as you can see from the chart, we had a pretty significant bounce back in the implied U.S. yield. Now, typically the yield from NOPA to USDA doesn't vary that much, but when you are where we are, which is kind of at the beginning of the season, you can have some odd relationships. And we won't know whether this is one of those months until we get the December data from NOPA at the beginning of February. But you can see that the jump from November to December is sort of surprisingly large. And there's some part of that you might be able to say, okay, well, that's explained by we were using old crop soybeans to crush in November, and now in December we're more into the new crop, and so December is more reflective of what the new crop yield will look like. And ultimately that may be true, and if it is, it will have a significant impact on production. Again, for every 1/10 of a pound that you change the yield, you gain or lose 225 million pounds of production. And the implied November yield is significantly above where we're projecting yields for the rest of the marketing year. You can see yields generally tend to rise kind of throughout the year. And so we would probably end up lifting our forecast by maybe almost about 1/10 of a pound if the November number actually holds up. And it looks like that's where yields are going to be going forward. So I wanted to highlight this. just because it's so important and because the data just came out and it was so much different than what we saw last year or last month. But again, I think we probably won't really know what we think about this number until we get USDA's confirmation of it in early February. All right, with that, let's get into biodiesel. So this is a chart that I've put up a lot, and it doesn't have a great relationship, but it shows the HOBO spread against the deviation in domestic biodiesel production from the 5-year average. And when I took the picture of this chart, there's two things, I guess, that I want to point out. One, the December number suggests that we're going to produce over the 5-year average, primarily because of kind of the typical seasonal increase in production in December relative to the other months. But we'll see whether that actually holds up or not. The other thing that I wanted to point out is where we've got biodiesel production for 2023, which is this group down here, which suggests that biodiesel production will be substantially below the 5-year average for the entire year. And that is due primarily to the fact that that we use the mandates to forecast production, and based on our assumption about what the split between renewable diesel and biodiesel would be as a percent of the total production, that's kind of where we ended up with renewable diesel. Now, the key question, though, is whether that's going to hold and whether we need to make some adjustments to our forecast for overall biomass-based diesel production, or we need to change the split between renewable diesel and biodiesel production to lift the renewable diesel implied capacity utilization. So this chart shows unadjusted capacity utilization for renewable diesel based on just the mandates and what the mandates say about production, both just from the biomass-based diesel mandate, but then also the implied ethanol gap and the undifferentiated advanced biofuel mandate. And you can see that the implied renewable diesel capacity utilization drops dramatically from where it has been historically. We're forecasting, and just to sort of clean up what we think about December, we're forecasting production of biodiesel to be 180 million gallons in December, and for renewable diesel to be 190 million gallons. Ultimately, that may be a little bit optimistic, but there it is. The more important part about this slide is really to notice where capacity utilization is. And so I firmly do not believe that the renewable diesel capacity that's going to come online in 2023 is going to open up and then operate at 40% capacity. So there has to be a change that raises that capacity utilization. And there are a couple of ways that this can happen. So the least likely is that we get big delays in the growth in renewable diesel capacity in 2023. Most of the 2023 plants are already under construction, have been under construction, and are probably going to open when we think they're going to open. For 2024 and 2025, 2024 is kind of a middle year production, or construction probably started at some point last year. And so maybe you get a little bit of slowdown in some of the plants that we're going to open at the end of the year. But for, again, plants that have started construction, it's going to be difficult to shift that capacity out far enough to make a significant difference in the capacity utilization rate. 2025, I think you could argue, okay, well, if the margins aren't there, then that capacity will shift out, and we could almost sort of just push our capacity out, the growth in capacity out into later years to raise the capacity utilization in 2025. The second way that you could do it is that you could say that the split between renewable diesel and biodiesel is going to change, effectively rationalize biodiesel capacity. And I think in the upcoming charts, you'll see this, but when I started to do that, it took, and I think maybe it's so this is effectively that method of raising capacity utilization. And so in order to get capacity utilization up to something that is sort of in line with historical, it takes basically renewable diesel producing 90% of all biomass-based diesel in 2023, 97% in 2024, and then 98% in 2025, based on our estimate of, again, the ethanol gap, undifferentiated advanced biomass-based diesel mandate, and then the biomass-based diesel mandate itself. And so what that says is that obviously that biodiesel capacity would need to really start to kind of fall off a cliff starting now and then through the end of the year. And if you don't do that, then that brings us to potentially the third change, which would be increasing the total output. And so instead of producing to just what the mandate suggests, we would add, and this chart reflects adding 2 billion gallons to overall production, leaving our assumption about the split between renewable diesel and biodiesel unchanged. And then that takes renewable diesel capacity again up to something that looks more in line with where we've been historically. And that 2 billion gallons of additional production suggests that we'll need 14 billion pounds, more than 14 billion, 15 billion pounds of at least of additional feedstocks, depending on exactly the feedstock mix. And this is why this is so important, because if we need 2 billion gallons of additional production, another 14 billion pounds of feedstock demand is going to have significant implications, not only for the fats and grease markets, but also for soybean oil and canola oil. And they are going to look a lot different than, their balance sheets are going to look a lot different than they do right now. Now, I think probably in 2023, the most likely outcome is maybe some combination of overproduction and rationalization of biodiesel capacity. However, in order to get that rationalization of biodiesel capacity, you need biodiesel margins to drop off really, really sharply. And right now, this week, our estimate for biodiesel margins in the California market were $1.25, which is below renewable diesel. Renewable diesel was still over $2. But if you go back about a year, biodiesel margins were 20 cents plus or minus sort of 20 cents, and mostly minus kind of 20 cents. And so there's that much work that needs to be done to rationalize biodiesel capacity. And there are essentially 3 ways that you can drive biodiesel margins down to rationalize biodiesel capacity. You can raise feedstock prices, you can lower energy prices, or you can lower credit prices. And so far, we haven't really seen feedstock prices running up. RIN prices have come down just ever so slightly this past week, but like we talked about last week, the spread between the D4 and the D6 RIN is narrow enough that it suggests that even if RIN prices are going to come down, I think they're going to come down relatively slowly. And so that suggests that it's probably not going to be credit prices that that take biodiesel capacity out. Energy, crude oil, and the derivative energy products have kind of, crude oil's kind of stabilized, rallied a little bit last week. It seems to be kind of stable somewhere between $70 and $80. And similarly, I think you're getting kind of the same thing starting to happen in renewable diesel and biodiesel prices, where they've come down a little bit, but they've started to stabilize. And so energy prices don't look like they're going to drop down enough to cause biodiesel producers to rationalize capacity. And so that really leaves feedstock prices. And so even if we don't need the additional 14, 15 billion pounds of feedstocks, even if you're going to say, okay, well, we're going to drive enough biodiesel capacity out of the industry to provide enough production for renewable diesel to raise its capacity utilization up. In order to do that, you probably need feedstock prices to rise. Now, I think that if I just had to say, okay, well, what would you look for as a sign that we're going to start to rationalize biodiesel capacity? Of those three choices, kind of what would you look for? And the thing that I would pay the closest attention to would be RIN prices. And I would expect a sort of a sharp break in RIN prices. Now, RIN prices are effectively an insurance policy on margins and most highly correlated with feedstock prices. So if you get feedstock prices rising, the natural thing would be to say that RIN prices would also need to rise. But if we are going to produce so much biomass-based diesel that we're going to way overproduce RINs relative to what the market needs, then RIN prices should actually break and probably break pretty hard. And again, that's not what we are seeing right now. All right, so what does 2 billion gallons of additional production over the next couple of years look like? Our forecast, unadjusted, just based on the mandates, are the gray boxes. And so you can see total biomass-based diesel production of 3.25 to 3.75 billion gallons. And then if we raise that up, we get to a little bit more than 5 billion gallons of biomass-based diesel production, which is a lot, which is obviously a really significant increase. It's almost 100% increase in production. So it's not something that I take lightly, or something that I think is like, I wouldn't bet my house on the fact that we're going to add 2 billion gallons of production. But just for one, illustrative purposes, and two, just in trying to model how all of this is going to work, that 2 billion gallon number again is the number that, if we keep biodiesel capacity close to where it is, kind of gets renewable diesel utilization rates up closer to where they've been historically. Now, again, I think maybe we get some combination of 1 billion gallons of additional production and a bit faster rationalization in biodiesel capacity than we're suggesting, although people have criticized our forecast for being a little too aggressive in our rationalization of biodiesel capacity. And what does that look like if we sort of split it up? So these are the numbers here on the right-hand side of the slide, the 53%, 77%, and 83%. That is the assumptions that we're using right now, unadjusted for the split between renewable diesel production and biodiesel production. And so you can see we have built in a pretty significant reduction in biodiesel capacity. 2022, it looks like it's going to end up pretty close to about 50-50, a little bit less than that, but just for frame of reference. So we don't have big decrease built into 2023. And then in 2024, we really start to knock down biodiesel capacity. And the thought behind that originally was, well, we're still going to have the blender's tax credit in 2023. And so that's going to help support biodiesel, and all of that is still true. And so we really don't have a chance to start to really rationalize biodiesel capacity until we shift from the blender's tax credit to the Inflation Reduction Act tax credit, which will reduce the values for producers with high CI scores. It's an LCFS-like credit, and so it will reduce the value for high CI producers, given that that soybean oil is a bigger percentage of biodiesel feedstock mix than renewable diesels. It kind of makes sense that should start to take out more biodiesel capacity. But again, people have thought, and not everybody, but some of the comments that I've had as I've sort of shown my stuff to people, is that maybe that 24-25 reduction in biodiesel capacity was a little bit too aggressive. And this is kind of what it looks like if we don't adjust it. So, wait, did I confuse these? I apologize. So this is, I'm sorry, this is what it looks like if we take, it's confusing on the right side here. This is what it looks like if we take biodiesel capacity down to that sort of 90% in 2023, and then effectively 98% or above in 2024 and 2025. And then this is what it looks like kind of if we assume our traditional biomass-based, the split between biodiesel and renewable diesel. And so you can see that biodiesel production still falls off sharply, and renewable diesel capacity grows, or renewable diesel production grows year over year, kind of modestly in 2023, and then starts to pick up in 2024 and 2025 as we drive biodiesel capacity out of the business. So one of the big questions, I think, about the idea of overproducing is, again, what will it do to the supply of RINs relative to what the market needs? And one of the ways to think about that is, what does the RIN bank look like at the end of the year? Now, I think last week I explained there are really significant challenges to estimating the RIN bank. And so please take these absolute numbers with a huge grain of salt, because I don't really think that that even if we don't add 2 billion gallons of production, that the RIN bank will grow this large. But there are some parts to estimating RIN retirements that are challenging. And so you get this build, and I think that ultimately the lines will be much flatter. However, the point here really is to show the difference between our assumptions before we add 2 billion gallons of production and our assumptions after we add 2 billion gallons of production. And you can see that the ultimate impact on the RIN bank is not that large. Now, I will also say that I've been trying to get all of this together, and the RIN bank part of it is something that I've been working on for a while. This part with the adjustment is something that I was trying to get done this morning, and I'm fairly sure that everything flowed through properly, but I'm a little surprised that the increase isn't bigger. And so I've got to go back and check this, but it may be that I come back to you next week and say, okay, well, actually, this is what this chart looks like, and it is a bigger build in the RIN bank. However, I don't know that the additional production is going to have such a huge impact on the RIN bank that that's sort of not the way that that the industry is going to go. All right, one final slide here just to show the challenge of driving biomass-based diesel capacity out of the industry. This is the spread between renewable diesel prices and biodiesel prices in the California market. Now, obviously, the California market is different than the rest of the country because it attracts more renewable diesel. As you can see, we ship about 72% of our domestic renewable diesel production into the California market. It's actually probably a little bit less than that because there's some foreign production in there. But we only ship about 17% of our biomass-based diesel production into the California market. And what has happened, oddly, is the spread between renewable diesel prices and biodiesel prices has actually flipped so that biodiesel is actually premium to renewable diesel now. And you can see that's not something that has happened historically. We were projecting that spread starts to narrow back towards zero kind of going forward. But the last 2 months, we've had big increases in it. Now, if you look at the prices today, it suggests that the spread is probably going to narrow, at least in January. But again, driving biomass-based diesel production capacity out of the industry when biodiesel prices are premium to renewable diesel prices, at least in the California market, is just another hurdle that makes it that much more difficult to get that done. And so ultimately, what I think I'm going to end up doing is, again, probably raising my production a little bit relative to what the mandates imply. I don't think I'm going to go with the full 2 billion gallons, and then we'll have to see what the EMTS data looks like for January and February, and then I'll have a better idea. I think it probably really will be because, again, of this typical seasonal pattern where production in January and February is relatively low. We'll have to see what happens kind of in March and April, and then going forward, and also have to see kind of how much of the renewable diesel capacity is actually going to come online in 2023. But I think what I'm going to end up doing is raising production to affect most of the change in the renewable diesel capacity utilization rates, and then probably cut a little bit more biodiesel capacity to sort of thin that out a little bit more. And I think it's probably going to be at least sort of 75% raising production and 25% reducing biodiesel capacity. But we'll see what happens with RIN prices going forward. And again, that's the number that I'm really focused on to see whether I think this theory is correct. If RIN prices don't break, and probably break pretty hard, then I'm going to believe that production is probably going to be driven more by capacity utilization rates than it is going to be driven by the mandates. If we do get a sharp break in RIN prices, then I probably will back down or back out whatever increase I built into production and start to become much more aggressive in my reduction in biodiesel capacity. All right, so that's the end of today's presentation. And it's 1:30, amazing. I actually did that in 30 minutes. Okay, so we're not going to go through the margin stuff today just because I wanted to talk about that, and I want to try and keep this part of it around 30 minutes. And so there are a couple of questions, so I'm going to answer a couple of questions, and then we will be done. Is it likely that producers would supply more than required by the EPA relative to the RVOs? Yeah, ultimately that is what this suggests. And if you look at the RIN Bank over time, I was going to do on that RIN Bank chart, I was going to do a longer chart for the RIN Bank so you could see a little bit better how the RIN Bank has moved over the years. The problem with that is, I think the last time the EPA, or at the least the last time that I can find an EPA reconciliation of the RIN Bank, where they actually published this is how many RINs are in the RIN Bank, is 2017. I suspect that there is one, or at least there should be reconciliations for 2018 and 2019, because it looks like the 2019 data is complete to me, but I just haven't found it yet. They used to put out a memo, and then it would appear in the Federal Register. So I think a while ago, I wrote the guy that used to put out the memo and asked him if he was still doing it. And I think his response was he wasn't still doing it, but it still appeared in the Federal Register, or they felt like there was enough data on the EPA website that you should be able to figure out what the RIN Bank was with the data that they provide. That may be the case, but I think if you've been doing this for a while, the difference between sort of what the data implies for the RIN Bank and then where the actual RIN Bank ended up in 2014, 15, 16, 17 was pretty dramatic. So I hope that it's just that I haven't found 2018 and 2019. They're really out there. And I also hope that the EPA starts to do this again. If you look at that historic RIN data, what you'll see is that through 2019, or at the end of 2019, we drew RINs down to a level that was at the lower end of the historical range. And I remember in 2020, there was a CEO of a company that is a relatively big trader in the RIN market. And the point of his letter or his article was he was worried that in 2020, the market might run out of RINs, because in 2019, our implied RIN bank is about 1.2 billion, which sounds like a lot, but again, is at the lower end of the historical range. And he did this sort of, during COVID, where people were concerned about what production might be. To me, it looks like in 2020, we started to build the RIN bank back again. And then obviously from that chart, it suggests that we'll kind of continue to build the RIN bank. And then the question is there sort of a tipping point in that build in the RIN bank that all of a sudden sort of causes RIN prices to collapse? Or just as we build the RIN bank, do we get sort of a natural pressure on RIN prices? And I think there's two ways to kind of think about that. The RIN bank on some level is our RINs that aren't necessarily actively trading in the market. And one, because you can carry RINs from year to year and use them for next year, the RIN bank can kind of be seen as sort of RINs that are almost out of the market and don't necessarily have the same impact on RIN prices as, say, if you take soybean oil stocks from 2 billion to 4 billion pounds, something like that. They still would have an impact, but it historically, I don't think it has been quite the same. The other thing is that in the Inflation Reduction Act, or I think it was actually as part of the legislation or the EPA's decision to eliminate small refinery exemptions, one of the things that they did was they said, okay, if you're a small refiner, you can use RINs from more than a year ago to meet your RVOs. And so in addition to the RIN Bank kind of being a little bit set apart from the market, there also is, I think, at least what the small refinery decision means is that the RIN Bank could be bigger, and the market may discount its size because you can go back and use more of the RINs to meet small refinery RVOs than you could historically. And so in that case, there's a bigger RIN bank, but there also is sort of additional demand that's created, and that would also kind of support the idea of a larger RIN bank not necessarily weighing on RIN prices as much. Could the draw from the EU be high enough to allow for utilization rates in the US to be high for both renewable diesel and biodiesel, or are the credits not high enough after considering having to retire the D4 RIN? It could be that that exports are significant enough to have an impact and may also contribute to sort of the solution here. However, that still implies higher production. That still implies sort of an additional kind of 2 billion gallons of production and the demand on feedstock. So it really, it's a little bit less about ultimately where the production goes and more about, are we actually going to produce more than the mandates imply, and then more than I think the market is currently pricing in? I think that in just to sort of bottom line this, I think that the market's reaction to the EPA mandates and conversations that I've had with people suggest that this is not the majority opinion, and that most people believe that the mandates are going to guide production or primarily drive production. And so there are times when being different than everybody else makes you feel kind of comfortable and happy. And then there are times, and I think this is one of those times, where I think, there are a lot of smart people at the big crushers and at the big renewable fuel producers that are also looking at this. And so far, I haven't heard any of them stand up and say, like, hey, look, I think we're going to produce another 2 billion gallons of renewable fuel, and we're going to need another 15 billion pounds of feedstocks. So that part makes me a little bit nervous, and I have been going through this and trying to figure this out for a while now. My initial reaction to the mandates was similar to what I think a lot of people's reaction was, which was they came in lower. I cut my feedstock demand pretty dramatically. USDA ended up not cutting their feedstock demand that much. And then as I sort of started to work through this capacity utilization problem kind of came up, and I started to look for ways to solve that. And when I couldn't really come up with a good way to solve it that didn't either require a big decline in renewable diesel capacity or a lot of additional production from the industry, then I started to look for things that were going on in the market that either sort of led me to believe that I was on the right path or that kind of told me that I wasn't on the right path. And I've been able to find some of both, quite frankly. So if you look at basis levels today for soybean oil, that doesn't suggest that the market is anticipating an additional 15 billion pounds of feedstock demand. But if you look at RIN prices today, again, they've come down a little bit, but they're still relatively high. And the spread between D4 and D6 is relatively narrow. And so that doesn't really suggest that that we're going to way overproduce biomass-based diesel. And so I think that one probably suggests that maybe we do need to produce more. It's something that I think I really believe that this question is going to either result in sort of feedstock prices that are, if we just go sort of basis soybean oil futures that are 60 cents and maybe 5 cents either side of 60 cents, with a sort of preference to be below 60 cents, or we're going to end up with feedstock prices that are at least 65 cents and again, sort of maybe a 5 cent range around 65 cents with a significant preference for prices that are above 65 cents and maybe, depending on exactly how much additional feedstock demand there is, maybe that's even sort of 5 cents one side or the other of 70 cents. Now, the one thing that I think that if we think about this from soybean oil price perspective, especially the futures market, the one thing that's very different this year than I think the last couple of years, and I've talked a little bit about this in recent weeks, is the fact that the world fundamental situation is much more well supplied, much more in equilibrium, much more bearish. Not that it's really bearish, but not as bullish as it's been the last couple of years. And so I think that shows up in the US export data. So gotten off to the slowest start for exports in 53 years, or the second slowest, whatever it is. And that's because there's no real pull from the world for soybean oil, in addition to the fact that domestically we need a lot of soybean oil. And so the only reason that I don't say that sort of the additional production means that soybean oil prices are going to be 70 cents, 5 cents one way or the other, is because the world situation is not quite as bullish as it has been the last couple of years. I think had this all happened last year, then I think we probably, if the market ultimately figured out, we probably would get a much faster and much more violent response than we'll get this year. I think this year we probably will move slowly higher. One, if this is right and people start to realize it, then I think it probably will take people a while to accept it. And then two, because the world situation isn't as bullish as it has been, I think that probably is going to limit the price reaction for soybean oil futures specifically. So the last thing I'll say is that in addition to RIN prices, so if I'm wrong, RIN prices should break, I think, sharply to drive biodiesel producers out of business. I think if I'm right, I think that feedstock prices should start to rise, and specifically the thing that I'm looking at as confirmation of this is the right way to go is soybean oil basis, RBD basis, and crude basis should also be rising pretty sharply if we're going to need another 15 billion, or even if you call it 5 billion pounds of feedstock demand, because what we've seen is that non-biofuel demand remains relatively strong. Now that could change if the economy goes into a recession, then that typically has a significant impact on non-biofuel demand. And that might temper any reaction in soybean oil basis. But those are kind of the two indicators that at least I'm looking at to try and figure out ultimately whether I'm right on this or not. Okay, with that, if there aren't any more questions, I will see everybody in 2 weeks, unless I see you in Tampa. Thanks for attending and have a great week. See you in a couple of weeks, everybody. Bye-bye.